Today is Sunday, December 6th. This is a post-market review for the stock market activities on Friday and an outlook for this upcoming week. I got a lot for you. This is going to be a heavy one. We're going to discuss everything from the market performance this week to the options activities to the insider trading activities. And this is a new one. We're going to review the jobs report during the headlines of the day segment, and I got a lot of charts for you. I've entered new trades this week. I will review those with you. We will talk about some of the open trades from the last few weeks and how to manage them. And lastly, in the conclusion of this video, I will present the case for the correction, the upcoming correction that is. And this is the bearish case. It will come with evidence, lots of evidence. And I will contrast that with the bullish case that argues that we are about to witness a market melt up of epic proportions. And I will show you the evidence that support that theory as well. With that being said, here we go. The Dow Industrial Average closing in the green, 248.74 points, or a gain of 0.83%. The Nasdaq also in the green, 87.05 points, or a gain of 0.70%. The S&P 500, similar story, green day, 32.40 points, or a gain of 0.88%. And what about the sector's performance on Friday? Leading the day, energy, and capturing the gold medal by far. Energy has been on a tear since post-elections. Remember the geniuses who told you that if Biden wins the elections, the energy sector will collapse further? We disagreed with that. We said that the election of the Democrats will be very good for energy, at least in the short term. This is what we're seeing right now. Materials at number 2 and capturing the silver medal. The bronze, it's a tie between industrials and real estate. The laggard of the day on Friday was utilities, the only sector closing in the red, yields popping higher. All of a sudden, we don't need utilities anymore. And here is the sector's performance for the week. At number 1, capturing the gold, materials. Number 2, and for the silver, energy, the bronze, and the third place goes to technology. Lagging the week, utilities, followed by consumer cyclicals and consumer defensives. Moving on to the futures market, let's see what happened on Friday. Crude oil, another gain of about 1% or so. We are closing at over $46, still far from the highs of the year. However, recovering really fast. What's going on with softs? Coca muted. However, we do have more news about the Coca wars, and now there's a massive shipment stuck in Nigeria. They're not letting it go, and all of these massive importers of coca, they found a loophole and a leeway for now by buying the beans directly from the exchanges. However, sooner or later, they're gonna have to face the music and go head and head against the farmers who are demanding extra pay via an additional tax for coca crops in Ghana and the Ivory Coast. You see the same story here happening in Nigeria. So if you like chocolate, you better get it now before it gets too expensive. Cotton, slightly in the green. The laggards of the day, OJ, coffee, sugar, all declining over 1.5%. However, we see lumber closing in the green and winning the day by far, almost 3% gain here. What's going on in metals? The notable action is in platinum. The tear continues. Platinum, the biggest gainer by far, no stopping sign here. Goes up and up and up, and you're seeing more bullish bets for platinum and miners in general. All of a sudden, the media and the experts on CNBC and such are arguing in favor of buying miners and materials. Meanwhile, in this channel, we told you to do that all the way back in July. And since then, you saw iron prices, copper prices, platinum prices rising significantly. But back to the day, gold and silver muted, copper again of over 1% and another 1% or so for palladium. Muted action, slightly in the red for meats. We do see more pain here for grains, specifically soybean meal, corn, wheat. However, the gainers of the day, soybean oil and oats. I am bullish on oats long term. And I have a story for you. We'll talk about it in the next video because this video has a ton of topics to talk about already. And right away, moving on to the big casino, the options market. Let's see what's going on. But before we cover the activities, let me share some of the good news with you. Remember the devil, aka SoftBank? They were gambling on options, call options during the summer, specifically in August, and they caused a massive gamma squeeze. Well, what a reverse in fortune here, because SoftBank will let go of their options gambling unit and activities due to investors' backlash. And by the way, they lost over $3 billion from these gambling activities, and turns out that their call options will expire in December 18th. And they're saying that they will let those options expire worthless. But back to the options market on Friday. The most active names were number 1, Apple with 1.3 million contracts, about 72% of those were calls. Tesla, number 2, about 1 million contracts here, with about 63% of those were calls. NIO at number 3, about 900,000 contracts exchanging hands on Friday. About 63% of those were calls. And we see notable activities here for AMD, Palantir. They're still gambling on those. However, we have a new table that's getting very hot, and we will see the migration from the Palantir, AMD, NIO, perhaps Tesla table to the new table of Fastly. 427,000 contracts traded for the day. About 81% of those were calls. So we are expecting a gamma squeeze here in Fastly, and depending on which name the ADHD Robinhoodian gamblers are going to abandon, that particular name will collapse, and the losses for that particular name will be to the gains of Fastly. My guess is they're going to leave the Palantir table because Palantir is down over 20% from the highs, and they have lost a lot of money gambling on this name. So they're moving to Fastly. And here are some interesting trades that took place on Friday. Right away, you see the massive, mammoth-sized trade for the SPY. They're buying the 350 puts, expiration date January 4th. And this trade is costing over 15 million bucks. So somebody is betting over 15 million bucks that the SPY will decline about 5% or so by the expiration date of January 4th. Now again, when I see trades like this, my guess is that this is a massive fund that wants to hedge. They're seeing danger ahead and they're buying insurance. 15 million bucks in insurance. But here is the bullish sentiment for Micron MU, and they're buying the 77.5 calls, expiration date January 15th, with expectation that the name will climb over 6% by then. And this is a significant trade as well because they paid over 7 million bucks for this one alone. And here we go, Fastly. They're buying the 100 calls, expiration date this upcoming week, with expectation that the name will climb over 13% by then. This trade is costing almost 5 million bucks. And here is a very interesting one for the XME, the metals and mining ETF. All of a sudden, everybody's bullish on metals and mining after the party has been going on for over 4 months already. And you see them buying the 37 calls, expiration date January 15th, with expectation that the name will gain over 13.5% by then. Now, why are we seeing all of a sudden a surge of bullish activities in mining and metals? The reason is the massive decline of the US dollar this week. And again, in this channel, we've been talking about this exact situation since the summer. And here is an interesting one for Taiwan, TSM. The bullish activities and bullish bets for this name continue to be very, very hot. They're buying the 109 calls, expiration date December 18th, and this is a very expensive trade, costing the trader about 3 million bucks. Here is another interesting trade for MGM Resorts. Casinos been on a tear since the massive rally in the IWM and the Pfizer vaccine news. This particular trader here is betting on a retreat and a pause in the rally, buying the 29 puts expiration date December 18th, and this one is a big one costing over $500,000 for this trade alone. And here is a very interesting one for Lennar, the ticker LEN. Home builder stocks been hit very hard throughout the week, and here is a trader betting on a rebound to the upside in Lennar, buying the 85 calls expiration date January 15th with expectation that the name will climb over 15% by then. And this trade is costing over $1.3 million. Continuing with interesting trades. Here is an interesting one for the XBI, the biotech ETF. It is a bearish one, buying the 116 puts, expiration date January 15th, with expectation that the ticker will decline over 15% by then. And again, this is an expensive trade costing about $800,000. Here is another notable one for AMD. They're buying the 103 calls, expiration date December 18th, with expectation that the name will climb over 9.5% by then. And again, this is a very expensive trade, costing the trader over $700,000. Another notable one for Lee Motors, the ticker LI. They're buying the 38 calls, expiration date December 18th, with expectation that the name will climb over 25% by then. And again, they're paying over $500,000 for this one. This is the insanity that is going on right now in the stock market, specifically in the derivatives market. They're bidding millions of dollars every week for very speculative trades, expecting names to climb 20, sometimes 30% in a matter of weeks. We're talking less than 2 weeks. But I guess some people have too much money than to know what to do with. Continuing, here is a very interesting one for Apple, and they're buying the 113 puts, expiration date New Year's Eve, with expectation that Apple will decline over 7.5% by then, and this is an expensive one costing about $500,000. Another notable one for Lowe's, the ticker LOW, and in this case they're buying the 157.5 calls, expiration date December 18th, with expectation that the name will climb over 5% by then. Once again, it is costing about $500,000 for this trade alone. Another one for Fastly, the 105 calls, expiration date this upcoming week. Here comes with the insanity and the expectation of the gamma squeeze, more than 18.5% gain by the end of the week to make this trade profitable. And again, it is costing over $500,000. And the last trade of the day for DocuSign, the ticker DOCU, and they're buying the 260 calls, expiration date this upcoming week, with expectation that the name will climb an additional 7% plus by the end of the week. Expensive trade costing about $1 million. And speaking about all of this gambling that's going on in the stock market and the options market from the retail side, what are insiders doing? They are dumping stock like there is no tomorrow. And here are the biggest dumpers for the month of November and the first week of December. Not in order, of course, but you can see the Netflix CEO dumping over $100 million worth of shares, the Walton family dumping almost $1 billion worth of shares, and you even see Mary Barra saying thank you for everybody who stampeded and pushed General Motors all the way almost to all-time highs, and she is cashing over $70 million. What about Nelson Peltz? He's dumping hundreds of millions of dollars worth of stocks, mainly from Cisco. I guess Nelson has his eyes on this $100 million painting, and he's just raising some cash to buy a new toy. What about Zucchiniberg? He's dumping about $300 million worth of shares. Similar story with Mickey Harrison, the chairman of Carnival Cruises, dumping over $100 million worth of shares. Meanwhile, the dummy retails are buying Carnival Cruises. The moral of the story here, you've heard throughout your life the saying that goes, the rich gets richer while the poor gets poorer. And it implies somehow that the system is rigged and there is some conspiracy. That is not true. The poor gets poorer because they're dumb. The rich dangles a little lottery ticket in front of the poor and the middle class, promising them that if they hand over their hard-earned money, they will get a chance becoming rich. In this case, in the stock market in 2020, retail stampedes. They're buying stocks left and right. They don't care about valuation. They don't care about anything. They're just buying with the blindfold on. The insiders say, you guys want to make us richer? Fine, we'll just sit out here and watch the show. Here comes a point where the rally becomes very excessive. Everything is overvalued. These insiders know that their stocks should not be trading anywhere near where they are right now. They dump, they get richer. And what are dumb retail like us doing? We're thinking to the moon, bro. You know what's gonna go to the moon? Your hopes and dreams. And they're never coming back. Insiders selling so they can buy their Christmas toys and have a great holiday season and lock in the low income taxes. Meanwhile, retail going all in. We've explained this via the call options activities, the highest ever and the highest inflow to the market ever. Retail going all in, buying the lottery ticket. It's all about mentality. What makes somebody successful or not. Greed is not good unless you're a corporate insider. Moving on to the headlines that shape the day. And right away, we are starting with the jobs report. And what a bomb that was. And here are the specifics. Last month, we've created over 245,000 jobs. Now that sounds impressive, right? Wrong. Because the expectations were for 470,000 jobs. So we are short by almost half. And just a reminder, the prior month, we've created over 610,000 jobs. So massive decline here in the momentum of creating jobs and regaining jobs. And this is a very, very alarming number showing that the recovery is slowing down significantly. And we might even dip into job losses again in December. Oh, and by the way, out of all these jobs that were created, the 200,000 plus, where were the majority of them created? Transportation, warehousing, aka the shitty Amazon jobs. That is it. Half of all of the jobs that were created in the service sector were temporary. This jobs report is stunning on how bad it is. And by the way, these employees that are getting jobs in warehousing and Amazon, how are they being treated? This is how. Major retailers like Walmart, Amazon, CVS turned record profits but did not pay employees much extra for working during the pandemic, and you report fines. Corporate slavery. They rig the system, they get richer in the process. The Fed stop the losses in their assets and inflate them even higher. They become richer in the middle of the most devastating economic crisis in our lifetimes. And they don't want to even reward their workers because it is corporate slavery. Back to the jobs report, and here are more alarming data the report shows. The permanent job losses did not improve one bit. We are still seeing a massive rise in permanent unemployment like we have never seen since the financial crisis. Furthermore, here is a very important indicator that suggests that permanent unemployment will increase further in the next few months and the picture will worsen significantly. Those who are unemployed for 27 weeks or more, the number ticked to over 3.9 million. These people are one jobs report away from being counted as permanently unemployed. And the saddest part is that the labor force participation continues to drop. We had a mini bounce off the lows and now we're trending lower. People are starting to give up on looking for jobs. The picture is dire. There's an enormous destruction and devastation in the state of employment and small business in this country. But rest assured, even after the horrific news of the jobs report, stocks went up. Why is that, you might ask? Here is why. More cocaine. The moment the market realized that the jobs report is stunningly awful, they rejoiced knowing that the Fed will supply the market with more cocaine. And right away, we heard from Chicago Fed President Evans, and he said that the jobs report is quote-unquote little disappointing. But rest assured that the Fed will continue to supply more cocaine because the jobs report is a little disappointing. Continuing with Evans, he went on to say, do not expect to raise rates until 2023, probably 2024, probably 2025, and maybe 2027, and maybe infinity and beyond. And here is more cocaine for you. Remember the BlackRock administration? Where they're saying that the jobs report was quote-unquote grim. Evans says a little disappointing. The BlackRock administration says grim, and I agree that it is grim. But again, rest assured, because the BlackRock administration is saying that we're going to get a stimulus this month and then more the next month. More cocaine for the market. Moving on to this very interesting story from Bloomberg. It reads, mystery surrounds 7 billion outflow from the Vanguard S&P 500 fund. And here is what happened. Somebody took over $7 billion out of the market this week without leaving a trail. How did that happen? I will read a little bit for you from the article, and then I will tell you and explain to you what really happened. More than $7 billion was pulled from the $172 billion Vanguard S&P 500 ETF, ticker VOO, on a single day this week, according to data compiled by Bloomberg. About 4% of the overall fund's assets. But trading volumes were below the one-year average, and there were no obvious outsized transactions, while the U.S. equity benchmark rose on the day, making a mass exodus less appealing. Continuing, we think the redemption did not show up because it was an outside primary market sale, said Eric whatever the hell, a Bloomberg intelligence ETF analyst. Rather than shopping for a tire at the store, this is like someone going straight to the tire maker, and that is rare since most ETF usage is smaller investors, quote unquote. When cash flows into an ETF, market maker, known as an authorized participant, gives the issuer more of the fund's underlying assets in exchange for new shares to meet demand. When money is being taken out, the process works in reverse. Continuing, it is not possible to know for certain who pulled out the cash. According to the latest available data, Bank of America is the largest holder of the fund, with shares worth about $14 billion. Raymond James Financials is the next with about $5.2 billion, followed by Paramedics Portfolio Associates with about $4.9 billion. The article continues. Spokespeople for Vanguard and Parametric declined to comment on the flows, while Bank of America and Raymond James did not immediately respond to requests for comment. Okay, let's comb through the bullshit and let me explain to you how this works. Remember, there's a secondary market and there's a primary market. The secondary market is where me and you participate. We buy in the secondary exchange. These are the NASDAQ, the NYSE, etc. But there is a primary market, and this is the direct market where you buy shares directly from the issuer, who uses primary market, big purchases, foreign government, entities, etc. And in this case, let's say it is the iShares, the SPY, whatever it is, when they issue ETF shares, meaning they want to issue more stock for the ETF. The authorized participant, in this case it could be JP Morgan, Goldman Sachs, whoever, they issue the shares to the market, to the exchanges, and they collect the underlying securities from the issuer. And what happens when somebody sells massive amount of shares in the secondary or the primary market is the reverse. The authorized participant, in this case, let's call it JP Morgan, will return some of the underlying securities and collect the ETF shares instead. So in this case, whoever sold the $7 billion, they went straight to the primary market. They sold a ton of shares for the VOO. And what happened is that the authorized participant collects the ETF shares and hand over an equivalent amount of the underlying securities in the ETF. Now, who would do such a thing and why? That is the mystery, isn't it? And my guess is it could be a foreign government here through a wealth fund going directly dumping shares, taking over some securities and cash. And this is why the trade did not register in the secondary market volume. But it is very interesting why, while the market is climbing higher and higher every day and the picture is supposed to be very bullish, somebody, some entity, in this case, very mysterious entity, very powerful entity, decided to dump $7 billion worth of the ETF. Perhaps they're bullish, on certain parts of the market, but bearish on others, and they don't want to hold the ETF and they're moving into stock picking instead. Again, very interesting move regardless of how you interpret it and look at it. But I'm curious, what do you guys think? Who's behind this transaction and why? Why are they taking the money out of the ETF and raising cash instead? Moving on to the heat map analysis for Friday. Let's see what happened here. Muted day for big tech. You see the big boxes of Apple, Microsoft, Facebook, Google, Amazon, all closing muted, some slightly in the red. And when we take a look at the tech sector here, we see that the outperformance is from chips. Taiwan gaining over 4% for the day, Intel another 2%, Qualcomm over 5%, Micron almost 5%, even Nvidia joining the rally in chips on Friday. AMAT, Lam Research over 3% apiece. Uber, the tear continues over 4% gain for Friday. What's going on in communication services? Muted day overall. We see Zoom declining just a little bit. However, video game names managed to outperform, specifically in this case Activision Blizzard over 2.5% for the day in gains. Moving on to consumer cyclicals. Right away, the notable underperformance comes from Home Depot, Lowe's, and the weakness in the housing and home builders continue. D.R. Horton, Lennar, all closing in the red. However, Toll Brothers closing in the green. Toll Brothers is reporting earnings on Monday, so that would be a very important day to watch for home builders. What about auto manufacturers? NIO, another day, another 5% or so to the downside. Ferrari got crashed on Friday, down over 2%. However, the winner of the day is Honda Motors, up over 2.5%. We see casinos doing very well on Friday. Cruises, with exception to Royal Caribbean. Hotels, Marriott is gaining about 2.5% again. And of course, in restaurants, Starbucks hitting all times high. What's going on with consumer defensives? We see big gains for Coca-Cola, up over 2%. The gains in tobacco continue. Tobacco has been very strong as of late. Philip Morris climbing about over 3% or so. Beer making a comeback. Budweiser, Diageo for liquor, similar story. And of course, the notable outperformers for the week are Cisco and Tyson. What about REITs? Green picture across the board with exception of Crown Castle, the ticker CCI, down over 2% for the day. Utilities. Every time we see yields climbing higher, utilities get whacked, and the pain here is in American Water. Dominion Energy down over 3%. Duke Energy over 1%. NextEra Energy also over 1%. What's going on with miners and basic materials? The strongest sector in the market right after energy. Here it is. Are you ready for it? Another day, another gain for copper. Freeport-McMoRan over 2.5% gains for the day. No stopping sign here. What about Valley? Another 4.5%, over 4.5% in gains for Friday. Remains a very hot name here. Valley right after Freeport-McMoRan. What's not working? Gold miners, another red day on Friday. Shifting to energy. The winner of the day, massive gains across the board. Exxon, Chevron, Kinder Morgan, British Petroleum, Phillips. They're all gaining massive gains for the day. And when we go to industrials, the winner is Caterpillar by far. Over 4% gain on Friday. Massive. You can only imagine how big the gains were in the options world for Caterpillar on Friday. General Electric, again, the squeeze continues via options, a gain of over 2.5%. Another massive winner in industrials on Friday's trading activities is Emerson Electric, one of my favorite names, over 6% gains in one day. The laggard in industrials was Boeing. Boeing down about 2% for the day. Moving on to healthcare, what is going on here? Eli Lilly is the biggest winner, over 3%, but we do see the massive gains in pharmacy names continue. CVS up over 2.7%, and Walgreens up over 1%. There are notable activities in the options market for Walgreens and CVS, pushing these two names higher and higher. The loser of the day is Moderna, down 3% or so. Of course, the name climbed higher after we heard the news that the Pfizer vaccine might be delayed. And then we heard the correction that the vaccine is not going to be delayed. And you see the volatility in Moderna, up 10% one day, down 6% the other. And here it is on Friday, closing down 3% or so. Moving on to financials, the tear in weaker names continues. Citibank is the winner of the day, over 3.6% gain, and the strength continues in credit services. We're talking about Amex, Visa, MasterCard, all closing in the green on Friday. PayPal, nothing new here. Another day, another close in the green. What is underperforming in financials? Right away, we see BlackRock down over 1.5%. What's going on here? I thought the BlackRock administration is supposed to be good for BlackRock. Moving on to the weekly heat map, and let's see what's going on here from a weekly perspective. Right away, we expected before the week started that Apple will be an outperformer. There you go. Apple closing about 5% to the upside this week. The notable gainer here in the tech sector is Intel, over 9.5%. The most boring name, the weakest name, all of a sudden outperforming for the week. Qualcomm, similar story, over 9% gains. AMD, Taiwan, all closing a massive week to the upside. AMAT and Lam Research are in the insane category right now, going straight up in vertical lines. What about the losers for the week in technology? Right away, you see CRM Salesforce down over 8.7% and Splunk SPLK down over 21% for the week. There are a lot of bets here on a rebound for Salesforce. I saw notable activities in the options market, people betting over and over that this name will rebound. We'll see what happens. But moving on to communication services, and here is the weekly scoreboard. Disney closing in the green, up almost 5% for the week. Netflix muted, less than 1.5% gains for the week. Video game names having a very good week. Activision Blizzard, Electronic Arts, all closing above 3.5%. Take-Two, just a little over 2.5%. Zoom is the weakest name in the communication services sector, down over 13% for the week. Shifting to consumer cyclicals, what do we see here? Muted action for Amazon, but more pain for Home Depot, Lowe's, Home Builder, DR Horton down over 6%, Lennar down almost 5%. And we'll also see Chinese names suffering here. Alibaba down over 3%, JD over 4%, and notable weakness here for Wayfair down over 8% or so. In addition to McDonald's lagging the rest of the restaurants' names. The outperformers are the reopening trade names such as casinos, cruises, hotels. Marriott closing another gain of over 5.5% for the week. And we see names like Ross, TJ Maxx all closing above 5% gains this week. Moving to consumer defensives, the biggest winner of the week is Philip Morris Tobacco, over 6% gains in a single week. Very impressive. Dyson, almost 8% gains. Cisco, almost 10% gains. These reopening names continue to march higher and higher. What is not working in consumer defensives? The loser of the week is Kroger, down over 5% after reporting earnings. We also see weakness in Target, down over 2.5%. Walmart down over 1.5%. And Kimberly-Clark down almost 3%. For the week. Moving on to REITs. The winner of the week is Simon Property, closing in the green by about 10%. We see the momentum in the IWM and the reopening names having another big week of gains. What is not working in REITs? Crown Castle, American Tower, down over 2% apiece. Moving on to utilities. Red picture across the board. Duke, NextEra, Dominion, American Water, all losing this week massively, over 3% apiece. The overperformer in utilities is First Energy, the ticker FE, closing the week above 8% worth of gains. Moving on to materials. Just to illustrate to you how massive these gains are in the metals sector. Freeport-McMoRan in copper, over 6.5% gains for the week. Valley, almost 9%. Even gold miners overall did significantly better this week when you compare it to last week. We see Barrick Gold closing over 3.5%. Newmount, a gain of over 1.5%. What about energy? Green picture across the board. The biggest gainer here in terms of big energy names is British Petroleum, BP, over 5.5%. However, the laggard of the day is PetroChina, the ticker PTR, down over 6%. And again, this company has been blacklisted by the US government for ties to the Chinese military. What's going on with industrials? Another big week for airlines and Boeing up almost 7.5% for the week. General Electric, over 4.5% for the week. Similar story with Caterpillar, 4% for the week. However, the majority of the gains happened on Friday. The laggard of the week in industrials is 3M, down over 2.5% for the week. What about healthcare? The winner right away, Pfizer, scoring gains of over 8%. We have J&J scoring over 4% gains this week. Similar story with Merck, over 2.5%. However, the loser here in the giant drug manufacturer names is Bristol Myers, down just over 1%. Big week for CVS, almost 10% gains, unbelievable. Walgreens, 11% gains. And check out Moderna, 20% in the green. The loser in biotech is Regeneron, down over 4%. We also saw big week for diagnostics. Thermo Fisher gains over 4.5%. Illumina, almost 10.5%, and a rebound in Dexcom gains over 9% for the week. What's going on with financials? The big banks, JP Morgan, Bank of America, these are all muted. The gainers are Wells Fargo, Citibank, about 3.5% gains apiece. Regionals, mixed picture here, but again, the big names such as US Bancorp and PNC, modest gains of about 2% or so. Credit services, the outperformer is AXP, American Express, gains of 3.69%. And we also saw gains in Goldman Sachs, Morgan Stanley. All in all, it was a good week for financials. And before we move on, let's take a look at the ETF heat map for the week and see what's going on. Right away, you see that the outperformance in the tech sector came from chips. When we look at ETFs for chips such as the SOXX, the SOXL, these are showing the majority of the gains. Energy outperforming the XOP, XLE, closing big in the green this week. And you see big gains for leverage ETFs, specifically for the NASDAQ, the TQQQs, gaining over 6% for the week. And the IWM made a last-minute comeback on Friday, closing over 2%. Again, all of these gains happened on Friday. And right away, you see that the leverage ETF, the TNA, gaining 6% for the week. The inverse index, the TZA, down 6.5% for the week. The notable activities here happen in international markets, specifically the Brazilian ETF EWZ, gains over 6%. And the bet here is on miners, specifically Vale. Massive bullish bets for that specific name, lifting the entire Brazilian ETF to make massive gains for the week. Another international ETF with massive gains this week is the South Korean market, and the ticker here is EWY, gains of over 6.5% for the week. And we're seeing more and more bullish bets, specifically for the EWZ, the Brazilian market. Perhaps it will cause another gamma squeeze, pushing the Brazilian ETF higher next week. What about emerging market in general? Doing pretty good, gains of about 1.5% for the week. And I expect that international markets, specifically emerging markets, will outperform the US market if the dollar continues to slide. Moving on to the rotation trade, here is the weekly score. All in all, there is no theme this week. You could argue that it is slightly toward the comeback stocks, but I don't see a theme here. What does that tell you? It tells you that there is passive inflow to the market. They're buying ETFs. They're not discriminating here. Of course, the retail side is now shifting into cruises and airlines, and they're buying Boeing, etc. So they are contributing to the upside in the reopening names. However, the ETF effect is clear when you look at these numbers. The stay-at-home names, the notable winners, Peloton over 5%, Apple almost 5%, and you see DocuSign reporting earnings over 7% gains. The laggard, of course, Zoom, after reporting its own earnings. And when we shift across the aisle, the biggest winner in the reopening names is Cisco, almost 10% to the upside. We know that Nelson Peltz been dumping stock left and right the last few weeks, affecting the gains of Cisco, but it is rebounding this week with massive gains. The laggard of the week in the reopening names General Motors down about 1.5%. Again, very extended, massive gains, and you see that the CEO herself is dumping shares. I dumped shares. Buying General Motors at these levels doesn't make any sense. Moving on to the charts analysis. What do we see here for the SPY from a weekly perspective? We're above all of the support levels, all-time highs. The sky's the limit. There's still a lot of room in the RSI from a weekly perspective for the SPY to have another melt up rally. You have to keep that in mind. The charts say that there is room for melt up rally, aka Santa Claus rally, aka Tom Lee rally, whatever you want to call it. Technically, there is room for the rally. Are there massive warning signals in the market right now? Yes, there are, and we will go through them in the conclusion of this video. But the charts are not calculating the risk for now. Moving on to the Qs weekly chart. What do we see here? Similar story with the SPY, closing above all-time highs. There is room for the RSI, for the Qs to run even hotter. The sky is the limit from this point on, and this is why I say, if you're gonna make bets, bearish bets, do not bet against technology names or even the SPY names. Pick against the extended overheated sector. What is that sector? Small caps. Here we go with the IWM. Another big week of gains. However, we're getting very extended here and getting overheated from an RSI perspective, MACD perspective, suggesting that we could see a rotation from small caps taking profits and moving those gains toward technology names, the lagging names. You saw Apple moving higher a little bit. Perhaps a lot of cash will be taken out, small caps, and move toward Apple, Microsoft, all the names that rallied during the summer, but lagging since September. Absent of a catalyst that will freak out the market and causes an overall crash, the rotation game back and forth will continue. We run the Qs hot, we shift to the IWM. We run the IWM hot, we shift back to the Qs. What's going on with the dollar index? Massive slide this week. And this is a weekly chart you're looking at, by the way. It is getting very close to my target of 88.5. More downside for the US dollar will mean more gains for basic materials, energy, and industrials. Three sectors you gotta keep your eye on. You can include consumer defensives. We're talking about Coca-Cola, Mondelez, Budweiser, etc. Because these names will benefit tremendously every time the dollar slides lower. And you're seeing very bullish bets in the options market regarding materials and metals. And here you see the dollar sliding down. And again, the dollar will continue to slide absent of any catalyst for a rally and a short covering squeeze. What would be that catalyst? Who knows? A black swan, stimulus falls apart, I don't know. But absent of that, the dollar will continue to slide. And if the dollar is going to continue to slide, what's going on with gold? Gold having a very big green week, recapturing the very important level of 1800, and the next challenge here is the level of 1925. Once again, if we reach the level of 1925, I will be taking my gains. Entry 1800, exit 1925. I expect a little bit of resistance at that level. Moving on to yields. Let's see what's going on. Yields were supposed to open lower on Friday. However, after the jobs report and the cocaine optimism, what happened? Yields climbed higher. Because if the jobs report is bad, this is the thinking of the market, of course. If the jobs report is bad, it means that we will have more cocaine support from the Fed and the federal government, aka the stimulus. And when that happens, right away they dump bonds, raising cash, moving that cash to equities, and you see yields climbing higher. Speaking of bonds, here is the TLT 15 minutes chart. Remember that we said we're looking for the head and shoulder formation, the reverse head and shoulder that is, to work to the upside, which it generally does. And the TLT was trading higher pre-market, as we expected. However, after the jobs report, you know the story. They sold bonds, moved to equities, and you see the TLT gapping lower. And here is a weekly chart of the VIX. The VIX remains weak. And if the weakness continue, we've been giving the VIX the benefit of the doubt over and over and over again. But if this formation continues, it is starting to look like a bear flag, which will take the VIX down to its natural habitat of 12. Now, if that happens, and you'll know right away, if we close below 20 in the VIX, it's going to be pretty much over. We're going to see the melt-up rally, and the VIX will melt down all the way to the level of 12, which is its natural habitat. Now, I can hear you already. Bears, I can hear you. You're saying, what are you saying here? Are you saying when I see a melt up? What are you talking about? Haven't you seen all the indicators and the put to call ratio? Hold your horses. We'll talk about that in the conclusion of the video. I'm just reading the charts as they're speaking to me. I cannot sugarcoat it for your bias. And here is Apple. Weekly chart. Right away, we talked last week about the bull flag formation playing to the upside. This is exactly what we got this week in Apple. And Apple is starting to look a little bullish here. A potential crossing to the upside in the MACD. There's a lot of room in the RSI before Apple gets overheated. And again, remember the level of 125. We could face a little bit of resistance there. However, defeating the resistance of 125 and closing above it will be very extremely bullish for Apple. Remember, I have a short position in Apple and I bought calls last week, meaning this week. Technically, we're still in the week. And I also bought calls for next week. This is how I hedge and protect my short position, is to participate in the Apple rally by buying calls. That doesn't change the long-term outlook for Apple in my perspective, by the way. I think that Apple will not live up to the expectations. Right now, everybody's waiting for the Q4 earnings, the new iPhone. I think all of that will come disappointing and Apple will correct. Remember, Apple had massive corrections throughout its history to the tune of 50% in a single year. So it is not out of the norm to see massive corrections for Apple, specifically after the very extended run this year. What about Tesla? Another hot name. What's going on here? We're watching the level of 599. Tesla still has some room to rally a little further here, but I am eyeing the RSI level of 84. If it reaches 84, I will short with both hands. For now, I'm just entering a small short position, but I'm still watching how the chart will behave. 599, strong resistance. Breaking above it will mean another surge higher, perhaps taking us all the way to the RSI level of 84. And my goal for the correction here is for Tesla to reach and retouch the trend line marked in yellow. You see it right there on the chart. Moving on to new trades I entered this week, starting with the XBI, the biotech ETF. What do we see here? Right away, my target was the level of 135. As soon as we hit there, I opened put options for the XBI and we declined just a little bit. And what do you know? Rebounding higher once again. So what do you do here? I look at the chart. I see the RSI very extended for an ETF. ETFs don't run this hot usually, meaning that we are facing an imminent correction here for the XBI. And the trade I opened is for January's expiration. And I did buy the 130 puts and I sold the 125. My goal is very defined. I'm looking for a small correction here in the biotech ETF. And since the trade has plenty of room, plenty of time for it to work, I will continue to add to the trade. Now here is another one that I entered this week for Occidental Petroleum, the ticker OXI. And I did buy a $15 put, expiration date December 18th. So we have 2 weeks for this one to work. And I sold the $15 puts, expiration date last Friday. Those expired worthless because Occidental Petroleum had a massive rally on Friday. And here is the chart of Occidental Petroleum to illustrate to you what happened. Right away, after I entered the trade, the name declined over 5%. But what do you know? Similar story with the XBI and the rest of the small cap / recovery names bouncing higher significantly. So what do you do from this point on? Remember, this is a small trade costing about 40 cents a piece. And this is how I'm going to manage it. I'm going to sell the $15 puts, expiration date this week to lower my entry price, hopefully all the way to 30 cents. After that, I will be looking for a reversal. Occidental is trading right now at about 18.5. Impulsive rally to the upside, but it is overextended. We have plenty of OPEC meetings and the back and forth between the producers that could affect energy names significantly. So if I see a signal of a reversal, I will average down my entry price further, perhaps at 20 cents or 25 cents a piece. And after that, the risk versus reward becomes in your favor. You still got 2 weeks for this trade to work. Any declines, not necessarily going all the way to 15. If your entry price is around 20-25 cents, the trade could become profitable very quickly. Here's another one for AMAT that I entered this week, and I bought the January 80 puts, and I'm waiting for the name to reverse and start declining, and I will turn this into a spread, and I will probably sell the 75 puts, same expiration date in January 15th, and doing it this way will lower your entry price significantly, meaning that you enter the position and then when there is a reversal and the trades start going your way, you turn it into a spread and thus capturing as much credit as you can, lowering your entry price as much as you can. When you lower your entry price as much as you can, your probability for the trade to become profitable increases. Here is another one for Deer, and you see the entry price here, 260.5, the exit 250 or 225.5. And you see the divergence lower in the RSI. Deer is starting to look weaker here. We're picking on the week, and I'm buying January puts. Again, I will turn it into a spread. Same strategy with AMAT, but since this is a more expensive stock, so I will leave $10 difference, and that would be my range of profitability, meaning that I bought the 240 puts, expiration date January 15th, and I will wait until the trades start to go my way and Deer to decline. Once the reversal happens, I will turn it into a spread and I will sell the 230 puts, same expiration date. That way I will manage to lower my entry price significantly. Now, what is the flip side of the coin? What if the trade goes against your way? How do you know? Right away, you see that the level I'm eyeing is 260.5. If Deer rallies above 260.5, closing above that level, you'll know that the trade is not going your way and you nip it in the bud right away. And here is the last one for DHI DR Horton. We're seeing weakness in the home builders names, and you see that this chart is forming a bearish head and shoulder formation, suggesting that this name will decline from this point on. In this case, I'm buying the January 65 puts, but I did not go all the way in because Toll Brothers is reporting earnings on Monday. And if Toll Brothers rally, guess what? DR Horton would rally as well. So just an opening position here. Wait and see for a confirmation after Toll Brothers earnings. Now, I still have some open trades from last week, and I'll go over some of them. But here's the take. This week was not good for these trades because we saw reversals from the declines and we saw a massive surge higher, specifically in some of the names. And I am glad that this happened because if the trades worked right away without any challenges, I would be here talking to you saying the trades worked, I closed them, took my profits, end the story, and now we're looking for the next trade. There is no educational value whatsoever. But because the trades are facing some challenges, we get more educational value from them on how to manage the trade, which trades should you add to, which trades should you abandon, and how to repair options trades when they're not going your way. Here is my rule. Think of each trade as an employee that you hired, you paid to make you money. If they do not make you money, stop feeding them. Stop giving them more money. It is not working. When you enter a trade and it's not working, stop digging yourself deeper by feeding it more and more money to average down. When do you average down? When your thesis that you entered the trade to begin with is still intact. And if the probability is still there, and here is what I mean. Here is a trade that worked tremendously for Palantir, and you see the entry price of 32. This is when I bought the puts, and I bought the 20 puts, expiration date December 18th. And what do you know? The name declined significantly this week. What did I do? I took profits, and on Friday, I rolled down, buying the 20 puts once again, this time around, for expiration date January 15th. What I see here is a bear flag formation. We could go a little higher in Palantir, but the trade is working, so I will feed it more. And when you look at the options market activities, where traders are now shifting from Palantir to Fastly, that is another piece of the puzzle that supports the theory. The technicals are on your side, the momentum in the options activities in your side. So this is a trade that I did put more money to work for. Now here is a trade that I'm not going to feed anymore, not pouring any more money on this one. For Alcoa, you see that the entry price was the $21, and we followed unusual activities in the options market by buying the 18.5 puts, expiration date December 18th. The trade worked for like a day. Alcoa declined over 6% and then had a massive rebound, gaining about 23%. 23% is a large number. You're far away from your target of 18.5. You got only 2 weeks to work. Yes, the RSI is extended and we should be looking for a downturn here. But again, the slide in the US dollar will continue to support the rally in metals. So until and unless I see a sign and a signal for a massive reversal in Alcoa, I am not feeding this trade anymore. To me, it's gone. It's a total loss. Now, if you're looking at this trade and you have not entered the trade yet, what do? You wait, you look for a sign of reversal because the RSI is very extended. So we know that the reversal is imminent, but there are factors supporting an extension of the rally. So what you do is you wait for a sign of reversal. What is a sign of reversal means? Closing below the lows of the prior day, bearish engulfing candles. Those are all signs for technical reversals. And then you enter the trade. However, you have to adjust your numbers higher now. Instead of buying the 18.5 puts, you're going to buy perhaps the 22 or the 21 puts, and you give yourself a little more time with buying January expiration instead. And in this case, the theory behind the trade could be right. The timing is wrong. I entered too early, but you might enter right in the sweet spot when the name is ready for a reversal. Now here's a trade that I will add to for JWN Nordstrom. And the reason is I got time. I have January puts. There is a lot of time till expiration. And the rally in Nordstrom is very extended. We're reaching very hot levels in the RSI, unprecedented levels, and we are looking for a massive reversal here. As soon as I entered the trade, the name declined over 14%, meaning that these options appreciated significantly right away. And that was an opportunity to take some profits off the table, because what happened after is Nordstrom rallied over 25%. Now, the difference between the Alcoa trade and JWN is Alcoa expiring December 18th, JWN expiring January 15th. Because I have time for this one, I can afford to put more money into it to work. Alcoa, the time is a little tight. It is not worth it to pour more money on that one. And again, you could be smarter than I am. The theory behind the reversal is right, but maybe I got a little too early. So you can look for the reversal this week and buy the 30 puts instead, or the 29 puts. You adjust higher, and you make your profitability probability a lot higher than mine, the bag holder, who are trying to average down. And here's a trade that worked right away, reached the target in 1 day, and then reversed lower, and that one is done. It's over. We're talking about Dominion Energy. Right away, the name bounced just a day after entering the trade, just 1 day after. You saw Dominion Energy rallying significantly over 3.5%, reaching the target of about 81 bucks, and those options were bought for about 60 cents a piece. At that point, they were worth about $1.20, meaning that they have doubled in value. Now, when you double your investment in a day, that is enough. You take your profits right away. You made 100% in 1 day. What more do you need? Because what happened after that is Dominion failed to crack the resistance, failed to catch the support of 78.35, and you see it flushing down significantly. Now here's the last one I want to talk about is Simon Properties. And you see right away after opening the trade, the name flushed down about 6.5%, and the way I opened this one is a spread. That is the beauty of opening a spread, because had I not opened a spread, my losses would have been a lot larger, because what happened in SPG is it rallied right away before reaching the target. It rebounded and rallied over 13.5%. Two situations here. Number one, let's talk about my situation, the bag holder situation. What do you do now? You have a resistance level coming up at 95.50. You want to look for a reversal here. And if you see a harsh reversal, then I'm going to add to my trade. And as we continue to slide lower, I will add to the sell leg from the spread to capture more credit and lower my entry price even lower. Remember, I bought the 80 puts, expiration date December 18th. These cost about $1.60 per option. And then I sold the 75 puts for about 70 cents a piece, and that took down my entry cost to 90 cents. Now, assuming things go my way and we see a reversal from 95.5, averaging down, and then as the name continues to slide lower, selling more of the 75 puts, and the goal is to average down my cost to about 50 cents a piece. When you entry price of 50 cents a piece, your probability for the trade to become profitable increases significantly, even if the name doesn't decline all the way to 80 by December 18th. This is kind of the repair work that you do for an options trade. Sometimes they're repairable, sometimes they're not. And the main factor here that would determine whether your trade is repairable or not is if you gave yourself enough time or not. If you give yourself just a week for the trade to work, if it doesn't go your way, it's over, it's done. It's not going to work anymore. And here is the other thing that I want to talk about, because I got messages from traders saying, hey, I agree, I think that Simon Properties is ready for a reversal, a correction coming, but I did not follow the trade at the time. What do I do now? Here's what you do. You're luckier than I am because you're not holding any back. What you do is you look for the next resistance level, 95.50, and you only enter the trade if you see a reversal, and again you adjust your prices a little higher. Don't buy the 80, that is way out of the money now, and what I'm doing is repair work for my trade. What you want to do is enter a new fresh trade that has a higher probability of being profitable. For example, if we see a reversal SPG from the level of 95.50, you probably want to buy the 90 puts and give yourself a little more time this time around to January 15th expiration. And by now you know the deal. As the name starts to trend your way to the lower side, if you bought the 90 puts, now what happened? The 85 puts, the 80 puts will also appreciate in value significantly. So what you do is you sell one of those and you turn it into a debit spread. Yes, it limits your upside, but it also lowers your entry price and gives you more probability for the trade to become profitable. That is your goal here, is to make profits, not to go to the moon, just make profits. And again, I get a lot of questions from traders saying, how do you repair an options trade when it doesn't go your way? I gave you a few examples here, so I hope that this was helpful to a certain extent. There are trades that you can repair, but there are trades, specifically the shorter term ones, it's just not worth it. If the trade is not working your way, stop feeding it more money, unless your thesis is still intact and there is more time for the trade to work out. Moving on to the conclusion of this video and the outlook for next week. We're going to do things here by reviewing what factors, indicators showing us that we should turn bearish and very cautious right here. I will show you some of these indicators one by one and build the case that the correction is very, very imminent right now. Number one is the Buffett indicator. Right away, you see that the total market value has reached 100% of the GDP's value, meaning that the stock market value is double what the entire GDP of the country is. That sounds insane because it is. And here is the second indicator. The price to earnings ratio for the market has reached all-time highs, meaning that you're paying the most expensive prices for these stocks from a historical perspective. And here is the third indicator of the very extreme bullish sentiment in the market. The total leveraged bull to bear ratio also all-time highs, meaning that investors are taking so much risk that they're investing in leveraged indices instead of regular indices. They're looking for more gains. Things are starting to get very, very greedy here. Indicator number 4, the excess optimism indicator at all-time highs, higher than the highs of the financial crisis, indicating that the majority of market participants are extremely optimistic, taking a lot of risk, thinking that there is only upside from this point on. Here is the 5th indicator, again showing you the mania. The call options activities reaching all-time highs. They're not investing in stocks anymore. They're taking the riskiest strategy, going all in, buying calls. And if these calls expire worthless, that's it. They're going to lose everything. And this is a very dangerous level of sentiment in the market right now. Next indicator regarding sentiment again, and you see that since November, the sentiment has surged extremely euphoric. Perma bulls are becoming even more perma bulls, more than ever before. Pragmatists, economists, even perma bears are now bullish in the market. So again, don't call me a perma bear, because perma bears don't exist. They're all turned into bulls right now. Here is the 7th indicator that there is a lot of danger ahead. We have seen in November the largest outflow from gold ever. They're dumping gold like there is no tomorrow, not looking for safety whatsoever. Risk on sentiment. Indicator number 8, the put to call ratio, again reaching 20 years low, lower than the dot-com bubble. Meaning, when you combine all the information so far, they're going all in leveraged indices, all in call options, all in with optimism. Even the perma bears are becoming perma bulls. They don't need gold anymore. And they don't need protection, put options, fix, not at all. All in, fully exposed to the risk and the danger ahead. Moreover, this is specific to tech stocks, the extension from 50 days moving average. Again, reaching levels that we have never seen before, extending farther than before the February crash. Very ominous signal here. Indicator number 10. If you're still counting, this is the S&P 500 cyclically adjusted PE ratio. It is reaching levels that we have not seen since the eve of the crash in 1929, only surpassed by the dot-com bubble. Indicator number 11, the percentage of stocks in the S&P 500 that are above the 200 days moving average. Again, we are reaching all times highs. The last time we've seen this was back in 2013. Here is another indicator for the S&P 500 Bollinger Bands. And we are now piercing above the upper level. When you reach the upper level, it suggests that you're going to see at least 2 months of declines in the stock market. Well, we're already there, and we've surpassed the upper limit of the Bollinger Band, showing extreme extension in the market here, which will require extreme correction to fix. Another indicator, the Russell 2000 in November, gaining over 18.3%, the highest ever since the gains of 16.4% back during February 2000, 1 month before the dot-com crash. And here is the last indicator of insider activities. Insiders, corporate executives are dumping stocks, not buying. Retail going all in, Naruto style, heads first, buying call options. Insiders saying, thank you so much, we're taking our Christmas money, goodbye. So here I showed you 14 indicators that are telling us danger ahead. Be very careful. Don't be complacent here. Protect yourself if you're long. If you're bearish and you want to short, there is a correction very, very imminently. Are market participants listening? Not at all. And here is what support the bullish case, and perhaps it is the reason why market participants are ignoring all of these danger and warning signals. Here it is. You ready for it? The cocaine, aka the money supply. I don't know if you looked at the chart of the M1 money supply, but recently, last month, it exploded higher again, meaning that the Fed pumped significant amount of cash to the market. And we know that the market has been trading in correlation to the money supply. More cocaine, higher highs. No cocaine, crash. What do we got last month? A lot of cocaine. Matter of fact, $500 billion in extra money supply from the Fed. And that only happened, by the way, in 1 week between November 16th and November 23rd. Now, if you think that the market is only going to follow the cocaine, and since we have $500 billion worth of it, which means that the market has a massive melt-up rally ahead of it. This is why I say this is the most dangerous stock market that we have ever experienced. Everything is overextended, suggesting that there is a massive correction about to hit. However, the Fed is pushing the bubble even higher. They want to pump it even bigger and bigger than it is right now, meaning that will only amplify the correction that will come. The challenge is, how long are they going to be able to delay that pop? That is the question. That is the $1 million question that no one has an answer for. Here is what I can tell you from my own experience. Back in August, when the stock market was climbing higher and higher every day, impulsively due to the gamma squeeze in the options market, I started hearing from bears saying that this market is so difficult, I'm starting to give up, I'm going to go to the bullish side, you cannot be a bear in this market. What do you know? The moment they shift their sentiment To become bulls, the market corrected massively in September. What happened this week? I got the same messages from you guys saying that you're about to give up, you cannot fight this market anymore, you're gonna switch to buying the market, buying calls, etc., etc. It's the same sentiment I saw back right before the September correction. Another indicator that we are very, very close for a correction. Now, what do you do with that information? How do you trade this market? This is not an investable market. I've already liquidated the majority of my stock positions. It's over. This is an options gambling market, and that is the only way you can play it right now. What am I doing? Buying puts in certain names that are very extended and imminent for a correction, but I'm also buying calls in the SPY for Friday's expiration, and I'm selling the Monday expiration. So this week I did the same thing. On Friday, I bought December 11th expiration date for the SPY, and I sold Monday. Monday expires worthless. I'm going to sell Wednesday. And this is how I play the upside. If there is a melt up, I will participate in it via the SPY calls. However, if there is a downside, I'm also prepared because I have put options in the most extended names. Remember, that is the purpose of options, is to de-risk, meaning that if you're betting your entire portfolio on a call or put option, you're doing it wrong. The whole purpose of options is times like these, defining and limiting your risk. That is all I got for you. I'll talk to you again on Monday. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.